Stop scrolling right now because what I'm about to share could save you thousands of dollars in 2026. The IRS just announced sweeping changes that will directly impact your wallet, especially if you're a senior citizen or an immigrant living in the United States. Missing these critical updates could cost you more money than you ever imagined. I'm going to walk you through every single detail you need to know. So stay with me until the end because the information I'm sharing in the final minutes could be the most valuable part of this entire video. Hello everyone, and a very warm welcome to Entry Status USA. I'm absolutely thrilled to have you here today because we're diving into one of the most important financial topics of the year. If you're new to our channel, welcome to the family. We're dedicated to bringing you the most accurate, up-to-date, and actionable information about living, working, and thriving in the United States. And if you're a returning viewer, thank you so much for your continued support and trust. Today's topic is absolutely critical, and I cannot stress this enough. We're going to be talking about the major IRS rule changes coming in 2026, and these changes are going to affect millions of Americans, particularly senior citizens and immigrants. Whether you've been living in the United States for decades or you've recently made America your home, these changes will impact your financial planning, your tax obligations, and ultimately how much money stays in your pocket versus how much goes to the government. Now, I know taxes aren't the most exciting topic in the world. Trust me, I get it. But here's the thing. Understanding these changes isn't just about compliance. It's about protecting your hard-earned money. It's about making smart financial decisions. It's about avoiding costly penalties and mistakes that could set you back thousands of dollars. So, I'm going to make this as clear, as straightforward, and as practical as possible. By the end of this video, you'll know exactly what you need to do to prepare for 2026 and beyond. The Internal Revenue Service, which most of us know simply as the IRS, updates tax rules every single year. Some years the changes are minor, just small adjustments here and there. But 2026 is different. The changes we're seeing for 2026 are substantial, and they touch on almost every aspect of taxation that matters to everyday Americans. We're talking about changes to standard deductions, adjustments to tax brackets, new requirements for reporting foreign income, stricter enforcement of retirement account distributions, and so much more. For seniors who are living on fixed incomes from Social Security, pensions, and retirement savings, these changes can make a real difference in your quality of life. We're talking about the difference between having enough money to enjoy your retirement years comfortably versus struggling to make ends meet. And for immigrants who are navigating the already complex U.S. tax system, often while dealing with income from multiple countries, understanding these rules isn't just helpful, it's absolutely essential. One of the biggest changes, and one that actually works in favor of most taxpayers, is the increase in standard deductions. Let me explain what this means in practical terms. The standard deduction is the amount of income you can earn without paying federal income tax on it. It's essentially a baseline amount that the IRS allows you to deduct from your total income before calculating how much tax you owe. The higher this deduction, the less taxable income you have, and therefore the less tax you pay. It's that simple. For the 2026 tax year, if you're filing as a single individual, your standard deduction is going up to $15,900. That's a significant increase from previous years, and it means more of your income is protected from taxation. For married couples who file their taxes jointly, this amount jumps all the way up to $31,800. And if you're filing as head of household, perhaps you're a single parent or you're supporting other family members, your standard deduction will be $23,900. Now, let me put this into perspective with a real-world example. Let's say you're a single filer and your total income for the year is $40,000. With a standard deduction of $15,900, your taxable income drops to $24,100. That's the amount the IRS will use to calculate your tax bill. Without that deduction, you'd be paying tax on the full $40,000, which would result in significantly higher taxes. This increase in the standard deduction could save the average middle-income family several hundred in federal taxes annually. But here's where it gets even better, and this is specifically for our senior viewers. If you're 65 years of age or older, you qualify for an additional standard deduction on top of what I just mentioned. This is the IRS's way of acknowledging that seniors often have higher medical expenses, are typically living on fixed incomes and deserve a bit of extra relief. For 2026, this additional deduction will be $2,000 if you're filing as single or as head of household. For married couples, each spouse who is 65 or older receives an additional $1,500. Let me give you an example of how powerful this can be. Imagine you and your spouse are both over 65 and you file jointly. You start with the base standard deduction of $31,800. Then you add $1,500 for yourself and another $1,500 for your spouse. That's $3,000 in additional deductions, bringing your total standard deduction to $34,800. If you're living on Social Security, a modest pension, and some retirement savings, this could mean that a huge portion of your income is completely tax-free. This is an enormous benefit that every senior should be taking full advantage of. Now let's talk about tax brackets, because understanding where you fall within the tax system is crucial for effective planning. The United States uses what's called a progressive tax system, which means that as your income increases, you pay a higher percentage in taxes on those additional dollars. The IRS maintains 7 different tax brackets, ranging from 10% at the lowest end all the way up to 37% for the highest earners. These brackets are adjusted every year for inflation, and that's important because without these adjustments, inflation alone could push you into a higher tax bracket, even though your actual purchasing power hasn't increased. For seniors, understanding these brackets is particularly important when you're taking distributions from retirement accounts like traditional IRAs or 401ks. Every dollar you withdraw from these accounts is taxed as ordinary income. So, if you're strategic about how much you withdraw and when you withdraw it, you can potentially stay in a lower tax bracket and keep significantly more of your retirement savings. For example, instead of taking a huge distribution in one year that pushes you into a higher bracket, you might spread those withdrawals over several years to stay in a lower bracket. This kind of planning can save you thousands of dollars over the course of your retirement. For immigrants, these tax brackets take on additional complexity because you may have income from multiple sources. You might have wages from a U.S. employer, business income if you're self-employed, rental income from properties, investment income, and potentially income from sources outside the United States. Understanding how all of these different income streams fit into the tax bracket structure helps you make smarter decisions about deductions, credits, and overall tax planning. Speaking of immigrants, let's dive deeper into some specific issues that affect those of you who have come to America from other countries. First and most important is understanding your tax residency status. If you hold a green card, you're automatically considered a U.S. resident for tax purposes. This means you must report your worldwide income to the IRS, not just the income you earn in the United States. Every dollar you make anywhere in the world must be reported on your U.S. tax return. Even if you don't have a green card, you might still be considered a tax resident if you meet what's called the substantial presence test. This is a calculation based on how many days you've been physically present in the United States over a 3-year period. The formula weighs the current year more heavily than previous years. But essentially, if you spend enough time in the United States, the IRS considers you a resident and expects you to report your global income. One of the major changes coming in 2026 is that the IRS is significantly enhancing its systems for tracking and verifying foreign income and foreign account holdings. The agency is investing heavily in technology and international information sharing agreements. This means they have better tools than ever before to detect unreported foreign income or undisclosed foreign bank accounts. Gone are the days when people could hide money in overseas accounts and assume the IRS would never find out. The international financial system is now highly transparent, with banks around the world sharing information with the IRS. This brings me to a critical requirement that many immigrants are either unaware of or don't fully understand: the Foreign Bank Account Report, commonly known as FBAR. If you have financial accounts outside the United States and the total combined value of all these accounts exceeds $10,000 at any point during the calendar year, you must file an FBAR. Notice I said at any point during the year. It doesn't matter if the balance was only above $10,000 for a single day. If it crossed that threshold even once, you have a filing requirement. And when I say financial accounts, I'm not just talking about checking and savings accounts. This includes investment accounts, brokerage accounts, mutual funds, retirement accounts held overseas, and even accounts where you have signature authority but don't actually own the money. The penalties for failing to file FBAR can be absolutely devastating. For non-willful violations, the penalty can be up to $10,000 per violation. But for willful violations where the government believes you intentionally hid these accounts, the penalty can reach 50% of the account balance. Imagine having a $100,000 account and facing a $50,000 penalty just for not reporting it. It's financially catastrophic. With the IRS's enhanced monitoring systems rolling out in 2026, the likelihood of getting caught if you fail to report has increased dramatically. The agency now has access to information from foreign banks, foreign governments, and international financial institutions. They can cross-reference this information with what you've reported on your tax returns. So, if you have foreign accounts, please make sure you're in compliance with FBAR requirements. The consequences of non-compliance are simply not worth the risk. Let's shift our focus now to Social Security benefits, which is a topic that affects millions of seniors across America. One of the biggest misconceptions I encounter is that Social Security benefits are completely tax-free. Unfortunately, that's not always the case. Whether your Social Security benefits are taxable depends on what the IRS calls your combined income. This is calculated by taking your adjusted gross income, adding any non-taxable interest you received, and then adding half of your Social Security benefits. For single filers, if your combined income exceeds $25,000, up to 50% of your Social Security benefits may be taxable. If your combined income exceeds $34,000, up to 85% of your benefits may be subject to taxation. For married couples filing jointly, these thresholds are $32,000 and $44,000, respectively. These are threshold amounts that haven't been adjusted for inflation in decades, which means more and more seniors are finding their Social Security benefits subject to taxation as their other income sources push them over these limits. In 2026, the IRS is implementing stricter verification processes to ensure proper reporting of Social Security income and accurate calculation of the taxable portion. If you know that your benefits are likely to be taxable, you have options. You can have federal income tax withheld directly from your Social Security payments. You simply complete a Form W-4V and submit it to the Social Security Administration, and they'll withhold 7, 10, 12, or 22% of your benefit for taxes. Alternatively, you can make quarterly estimated tax payments to the IRS. The key is to avoid getting hit with a massive tax bill when you file your return, along with potential penalties for underpayment. Retirement accounts represent another area of major focus for the IRS in 2026, and this is something every senior needs to understand thoroughly. Under recent legislation known as the Secure 2.0 Act, the age for required minimum distributions, or RMDs, has been increased to 73. Once you reach this age, you are legally required to start withdrawing money from your traditional IRA and 401k accounts each year, whether you need the money or not. The amount you must withdraw is calculated based on your account balance and life expectancy tables provided by the IRS. The older you get, the higher the percentage you must withdraw. And here's the kicker. If you fail to take your required minimum distribution, or if you take less than the required amount, the penalty is severe. You'll owe a penalty equal to 50% of the amount you should have withdrawn but didn't. Think about that for a moment. If your RMD was $20,000 and you completely forgot about it and took nothing, you'd owe a $10,000 penalty in addition to the regular income tax on the $20,000 when you eventually withdraw it. In 2026, the IRS is rolling out improved tracking systems specifically designed to identify individuals who miss their RMDs or who don't take enough. They're matching information from financial institutions against what taxpayers report on their returns. This automated matching makes it much harder to slip through the cracks. The lesson here is clear. If you're 73 or older, make absolutely certain you're taking your required distributions on time. However, there are smart strategies you can employ when it comes to retirement account planning. For instance, you might consider taking distributions earlier in your retirement during years when you're in a lower tax bracket, even before you're required to take RMDs. You could also explore Roth conversions during low-income years. With a Roth conversion, you pay tax now on the converted amount, but then the money grows tax-free, and you can withdraw it tax-free in the future. And Roth IRAs don't have required minimum distributions during your lifetime. These strategies require careful planning, but they can result in substantial tax savings over the course of your retirement. For seniors, taking required minimum distributions. Remember that the deadline is December 31st for most years, although your very first RMD can be delayed until April 1st of the year following the year you turn 73. However, if you delay that first distribution, you'll have to take 2 distributions in 1 year, which could push you into a higher tax bracket and result in a larger tax bill. The IRS has significantly ramped up its enforcement capabilities in recent years, and this trend is continuing and accelerating into 2026. The agency received substantial additional funding to enhance technology, hire more auditors, and improve compliance programs. This means there's a genuinely higher likelihood of audits, particularly for high-income taxpayers, those with complex international transactions, and those claiming certain credits and deductions that are commonly abused. The consequences of non-compliance can be severe, ranging from accuracy-related penalties of 20% of the underpayment to fraud penalties of 75% to interest charges that compound over time, and in extreme cases of willful tax evasion, even criminal prosecution. However, the IRS also recognizes that honest mistakes happen. If you discover an error on a previously filed return, you can and should file an amended return using Form 1040X to correct it. Being proactive about fixing mistakes demonstrates good faith and can help minimize or eliminate penalties. Given the complexity of the tax code and the significant changes taking effect in 2026, I want to talk about the value of seeking professional help. Certified public accountants, enrolled agents, and tax attorneys specialize in tax planning and compliance. A good tax professional doesn't just prepare your return. They help you plan throughout the year to minimize your tax burden legally. They can identify deductions and credits you might not know about, ensure you're in compliance with all reporting requirements, help you navigate complex situations, and develop long-term strategies to minimize your lifetime tax burden. Yes, there's a cost to hiring a professional. Depending on the complexity of your situation, you might pay anywhere from a few hundred to several thousand for professional tax services. But in most cases, the savings they identify and the penalties they help you avoid far exceed their fees. This is especially true if you have complex situations involving foreign income, substantial retirement accounts, business income, rental properties, or significant investment portfolios. Even the peace of mind knowing your taxes are done correctly is worth the investment for many people. Don't forget about state taxes, which can vary dramatically depending on where you live and can have a huge impact on your overall tax burden. Some states like Florida, Texas, Nevada, and Washington have no state income tax at all, making them very attractive for retirees and high-income individuals. Every dollar you don't pay to the state is a dollar that stays in your pocket. Other states like California, New York, and New Jersey have high income tax rates that can exceed 10% for top earners. And when you combine that with federal taxes, you could be paying 40% or more of your income in taxes. Some states tax Social Security benefits while others don't. Some states offer favorable treatment for pension income or retirement account distributions. If you're retired or approaching retirement, the state you choose to live in can have an enormous impact on your financial security. Many retirees strategically relocate to low-tax or no-tax states specifically to preserve more of their retirement income. When you're living on a fixed income, saving 5 or 10% in state taxes can make the difference between a comfortable retirement and constantly worrying about money. So those are the major IRS rule changes and critical considerations for 2026 that every senior and immigrant living in the United States needs to understand and prepare for. I know we covered a tremendous amount of information today and your head might be spinning a little bit, but that's okay. The most important takeaway from this entire video is this: staying informed and taking a proactive approach to tax planning can save you substantial money and help you avoid costly mistakes that could derail your financial security. Every person's situation is unique. You might be a senior living solely on Social Security, or you might have substantial retirement accounts and investment income. You might be a recent immigrant just learning the U.S. tax system, or you might have been here for years but still have financial ties to your home country. Whatever your situation, generic advice doesn't apply to everyone. That's why it's so important to take time to understand your specific circumstances and not hesitate to seek professional guidance when you need it. Tax laws are complex. They're constantly evolving, and staying updated requires ongoing effort. But making that commitment to stay informed is one of the best financial decisions you can possibly make. The information I've shared today gives you a solid foundation. But don't stop here. Continue learning, ask questions, and stay engaged with reliable sources of financial information. If you found today's video helpful and informative, I would absolutely love it if you could show your support by giving this video a thumbs up. It helps us reach more people who need this critical information. And if you haven't already, please subscribe to Entry Status USA so you never miss important content like this. We publish regular videos covering immigration, tax issues, financial planning, and everything else you need to know about living successfully in the United States. Make sure you hit that notification bell too, so YouTube alerts you immediately whenever we upload new content. I also want to hear from you in the comment section below. Do you have questions about anything we covered today? Is there a specific tax situation you're dealing with that you'd like us to address in a future video? Are there other topics related to living in America that you'd like us to cover? Your feedback is incredibly valuable to us because it helps us create content that truly serves your needs and answers your most pressing questions. And please share this video with your friends, family members, colleagues, and anyone else you know who is living in the United States. This information could be just as valuable and important for them as it hopefully has been for you. Whether they're seniors planning for retirement, immigrants navigating the tax system, or anyone in between, the changes coming in 2026 will affect millions of Americans, and knowledge is power when it comes to protecting your financial future. Here at Entry Status USA, we are deeply committed to providing you with accurate, timely, and actionable information that helps you make better decisions and live your best life in America. We're here to cut through the confusion, break down complex topics into understandable terms, and give you the tools you need to succeed. Thank you so much for spending your valuable time with me today. I truly appreciate each and every one of you. Take care of yourselves, stay informed, and I'll see you in the next video. Until then, wishing you financial success and peace of mind as we head into 2026 and beyond.